This is The Business Experience Show, where we connect those who want to know more about digital marketing, social media, and business strategy with entrepreneurs who are succeeding in today's marketplace. Follow our blog, join our online network, or connect with us at thebusinessexperienceshow.com. And now, your host, Lisa Caprelli.
Welcome to the Business Experience Show. With me is business show producer Brian Gapps. The following information is provided for general advice. It is not legal or tax advice. You, our listeners, have very unique situations and should consult with a qualified attorney or tax advisor before making decisions regarding your financial planning or other business decisions. Today we have Quintessential Financial to discuss retirement investment strategy, financial protection, and looking to the future. He is my BFF, teaching me how to build my financial future. Welcome, certified financial planner and president of Quintessential Financial, Scot Shier.
Hello, Lisa. Thank you. And it's great to be on the show.
First, I want to say that being a numbers guy, helping people plan their finances, and all the experience you have to be in your field. Why did you become a financial planner? What really gets you excited about wealth building?
You know, to me, it's like putting together a jigsaw puzzle. When I meet with a new client, they've got all those pieces of their financial life, their investments, the taxes, the insurance, their goals, their financial future. Putting all those together, it's like bringing together the pieces of a puzzle, trying to create a beautiful picture. So that's really what I feel like I'm doing for people.
All businesses go through a growing stage. So let's assume I'm one. Should I be concerned with retirement planning at this phase?
I know it's hard at the beginning because everyone's focused on their baby, their business, and the long-term future for that. But you have to realize most businesses aren't profitable usually for 2 or 3 years. So it's important, it's essential that you have a good reserve, a good savings built up before starting that venture.
And assume I have the savings. Now, what do I do with that?
Well, good point. Most people, they'll have their savings in the bank where it's earning, what, in round numbers, what would you say? 0%? Yeah,
today?
Big round numbers, yes. But yet, even with that, because we're saying businesses are generally running negative cash flow initially, what happens if they go bankrupt? All that savings is going to be claimed by creditors.
So what should I do?
I would say start shifting that money right away into a Roth IRA. Beauty of a Roth IRA is that it grows tax-free, but it's also protected from creditors, bankruptcy creditors, for up to $1 million, and that's by federal statute. I'm not an attorney, so do consult with an attorney if this is a serious issue for you.
And let's clarify for our audience the difference between an IRA and a Roth IRA.
Yeah, there is some important differences. The traditional or original IRA allows you to put money in pre-tax or tax deductible. You can put in up to $5,000 before taxes, but anything coming out of that IRA will be taxable, including your gains. So and if you're pulling it out before age 60, 59 and a half specifically, the IRS will assess you an additional 10% penalty on what they call early withdrawals. But there's still a great account. All that money is growing tax deferred, so it doesn't get taxed until you go to pull it out. But if you're that startup business owner, I suggest the Roth IRA. With the Roth IRA, you don't get an immediate tax deduction, but you get tax-free growth. So everything will come out tax-free later on. And what's beautiful for this startup business owner, you need liquidity. You can pull out whatever you put in, your principal, can come out at any time, any reason, no taxes, no penalties. It's great.
Wow. And are IRAs riskier than other investments or savings?
I know a lot of people think the IRA is the investment. It's not. The IRA is just a shell. The IRS says if you title your account as an IRA, then it gets these tax advantaged and asset protection features to it. But what you put into the IRA is up to you. So if you're using this IRA for your liquid savings, put liquid safe investments into it. You can even put bank CDs in there or money market accounts. And then later on, as you want to get more aggressive and get growth, then you can put it into mutual funds and stocks and bonds, real estate, options, etc.
So I'm a business owner. Say I've had my business for 7 years now. How would I know where to start if I haven't done any of these things?
Lisa, you come to your BFF, your builder of financial futures. Scott, I'm here for you.
That is great information because I know there's a lot of people that have taken advantage of having an IRA or a Roth IRA. And there's business owners I know that haven't done a thing. They just kind of avoid it, and I don't know why they avoid it. That would be another show.
A whole nother show. The whole, if you don't look at it, it's not really there. No. The important thing with so many of these financial vehicles is that knowing about them doesn't do you any good. It's actually using them. And the nice thing with the IRA, you can't do a whole lot with it. The IRA, it's a good deal, but they limit you to only $5,000 a year. And that's less than $100 a week. So if you just start putting away $100 a week systematically, over time, it can grow tremendously for you. Matter of fact, there's a thing we call the miracle of compound interest. And let me just give you an example of how that works. If your money was earning 8% a year, I'm not guaranteeing that, but hypothetically, if you were earning 8% a year and putting in, $5,000 a year, less than $100 a week, over 20 years, that would grow to just about $250,000.
Wow.
That's pretty great.
And we took the liberty, audience, of putting the miracle of compound interest charts on our website, thebusinessexperienceshow.com. You are listening to Scot Shier from Quintessential Financial, your new BFF, building your financial future. So that's why you want to start today, not 1 or 3 years from now.
Correct, and that's why you want to do it in a tax-advantaged account like an IRA. On that chart, if people go to your website, they'll see what if they had put that into it shows if you put it into a tax-advantaged account where it's not being taxed. But if they left it in their regular savings account, if they were just at a tax rate of 28%, that money, instead of being close to $250,000, would be down to $190,000. And if they're in the top tax bracket, it would drop down to $165,000. That's a huge difference. We want to get all the money we can, don't we?
Yeah, and so $5,000 a year really can make a difference. It doesn't seem like much, but it certainly can over time.
Absolutely.
Now, I think advertising over the years has sort of lumped together IRAs with investment, and so I think people confuse it. I know you've just explained it, that it's really a shell, but it really is just a structure, and it can include holdings for your money.
Correct. And I can't really get into the investments because of regulatory things. Those have to be on an individual basis. But within that IRA, you are able to put in almost any investment into that IRA. There are a few limitations.
But you could also include just a bank savings account or a money market.
Correct.
So let's talk about college planning for those of us who have children and how you can benefit from tying in college plan and savings with IRAs or Roth IRAs.
Yeah, Lisa, children are something I know a lot about since I have 5 of them, and they're all juniors in high school right now.
He has 5 children, thus the name Quintessential, Quint for quintuplets, Quintessential Financial. Great plug for you there and your family, Scott.
Thanks, Lisa. Yeah, one of the things that I learned in going through the college planning process for them is that the federal aid forms, the FAFSA form, it looks at all of your assets, but not at your IRA assets. So let me clarify for this. Okay. If you've been building up in your savings account for your kids, they're going to say for every $100 that you saved up, you'll lose $5.6 in potential aid for your kids going to college. So if you've built up like $100,000, you're going to lose $5,600 each year in potential college aid. But if you'd been shifting that into your IRAs, the IRAs are invisible to that federal aid form. It doesn't look at those. So start early, shifting your money into the IRAs, and then you'll get a lot more help for college.
Start when your children are in elementary school, not high school or the year before college. And so many people do not do that. This is so important. Yeah. If you have children, if you're thinking about having children, you want to meet with a financial planner. Scot Shier is here to help you, Quintessential Financial. You can go to our website, thebusinessexperienceshow.com, and click on his little QF logo for Quintessential Financial. And I really think you should be speaking at elementary schools, and because you're helping people. And I've never had, I have a son in elementary school, and I've never seen a financial planner coming to my school saying the importance of this.
So far, we're talking about how to shelter more $5,000 a year, roughly. But I know there are other plans for more. And so let's say my business is taking off and I'm putting away money. And what else can I do?
There are a myriad of additional plans as the cash flow from your business starts increasing. The next one that I would take a business owner to normally is called the SEP IRA, and that stands for Simplified Employee Pension Plan. And it's basically a traditional IRA, but instead of funding it with $5,000, you fund it with 20% of your earnings from your sole proprietorship, from your individual business, or if you're set up as a corporation, you're actually allowed to fund it with 25% of the earnings that you paid yourself from the corporation. And that percentage is capped at $50,000. So you can put, and this is amazing, you can put 20 to 25% of what you made from your business into this traditional IRA plan called a SEP IRA, and that's in addition to your regular IRA, whether Roth or traditional contributions.
Why would I do a SEP versus a Roth, or can I do a combination thereof?
Do them both.
Great.
Take advantage of both. The Roth is giving you that tax-free growth and easy access to your money. The traditional and SEP IRA, generally the money you put in there, you want to leave to retirement because you will get penalized if you pull it out early. But you get that full tax deduction on the money going in there. So if you're making good money, say you're making $100,000, put $20,000 into your SEP. If you're making $250,000, put $50,000 into your SEP.
And don't leave it in your sitting in your checking or savings account earning 0%.
Right, where creditors and the college calculators will get it.
But what we're talking about is something that has sort of a financial maximum per year, and the other is more of a percentage off your business profits.
Correct. So with the traditional and Roth IRAs, you're limited to $5,000 a year. That was in 2012, $5,500 in 2013. Plus there's a catch-up provision, too, where you can put an additional $1,000 into those if you're over age 50.
Right.
The SEP IRA's percentage, 20% of what you made as a sole proprietor or 25% of what you were paid from your company. Now, couple of caveats on there. With the SEP plan, another great feature of that is that you have the timeline to fund your SEP is when you file your taxes for your business, including extensions. That means you have until as late as October 15th to take a huge write-off on your taxes for last year. So
that's great information.
You can reduce your taxable income for last year by 20 to 25%. And you have until October 15th of this year to do it, or whenever you file your taxes if sooner. The regular IRAs, their deadline is April 15th. So make sure you don't get the two confused.
And Scott, I want to touch on, you said a little while ago, and this was important, a way of protecting your money from creditors. Can you go into that a little bit for businesses?
There's two areas of protection in the IRAs. And again, I have to put my caveat. I'm not an attorney. And if this is really applicable to you, please do consult with an attorney.
You practice in California.
Correct.
As well. So a lot of this information applies to California.
Well, and each state is different. Now, the federal statute of $1 million of protection for the IRAs, that's a federal statute. But the protection against lawsuits varies from state to state. And in California, they leave it up to the judge to determine how much of your retirement account, of your IRA accounts, are protected from lawsuits against you. Not bankruptcy, that's different, but just lawsuits.
Some people still don't see the basic need of saving for the future. I mean, you can talk strategy all you want, but they still aren't saving.
Absolutely. For everybody, the first step is really a basic budget. You've got to figure out where's your money going, where's it coming from, and where's it going. And the key to building wealth is you have to spend less than you make. And then what do you do with the difference? And I would suggest you want to shift that difference into the Roth IRA first. That's a great place for your liquid savings. And then as your income increases and you want more tax deductions, then you start doing the SEP IRAs. And then we can start looking at a whole variety of other retirement plans, especially as your business starts bringing on employees and other things. That opens up a whole other cornucopia of investment and planning options.
And of course, the importance of sooner rather than later. I mean, when is the right time to start?
Gee, let me think. Now. Now is always better than later. And that gets back to the chart on your website on the miracle of compounding interest. The $5,000 you put in today, if you waited 20 years, you'd have to put in $25,000 to have the same amount that $5,000 today is worth at an 8% interest rate.
Well, I think the key is to start now. Don't put off your future, which is what we all have. Well, we have a great foundation here for some simple investment and retirement strategies for small businesses. For more information on how to save money and make money, Scot Shier's retirement lesson and contact information is available to you. All of our shows are available as downloads on iTunes, iCatcher, Downcast, and all other podcast directories. If you know someone who can benefit from today's retirement lesson and BFF, Building Your Financial Future, all you have to do is go to our website, thebusinessexperienceshow.com. Click on Quintessential Financial, your new BFF, Building Your Financial Future. Any last words for our listeners, Scott?
Start now, start early, and build for your future. Thanks, Lisa.
Thank you for today's lesson, Quintessential Financial. If you're a business owner or entrepreneur and have knowledge to share, we'd love to hear from you. Go to thebusinessexperienceshow.com and contact us today. You're listening to the Business Experience Show on Angels Radio AM 830 KLAA. I'm Lisa Caprelli with Brian Gapps. Thanks to Scot Shier from Quintessential Financial. The preceding is provided for general advice. It is not legal or tax advice. You, our listeners, have very unique situations and should consult with a qualified attorney or tax advisor before making decisions regarding your financial planning or other business decisions.